Hello friends, welcome to my channel. Today we will discuss insurance part 4. Alternative organizational forms. In addition to significant variation in distribution methods, insurance markets are characterized by a variety of organizational forms including stockholder ownership, mutual ownership, reciprocals, and Lloyd's associations. Myers and Smith 2013 described the main types of and survey the literature on choice of organization form with an emphasis on the ability of alternative forms to reduce contracting costs associated with potential incentive conflicts among owners, residual claimants, managers, and policyholders. Myers and Smith 1981 considered the ability of alternative forms of ownership to minimize the cost of incentive conflicts. Also see Fama and Jansen 1983. They predict that mutuals will specialize in lines of insurance where managers have limited discretion to pursue their own interest at the expense of owners, whereas Lloyd's associations should have greater penetration in lines where managers have the most discretion. Myers and Smith 1988 discuss further the management discretion hypothesis, and they developed test hypotheses concerning product specialization and geographic concentration across ownership types. Also see Myers and Smith 1986. They obtain some evidence consistent with the prediction, for example, that mutual specialize in lines with the low managerial discretion. Myers and Smith 1990 analyzed the insurance purchases for U.S. property casualty insurance. Also see Myers and Smith 1982 providing evidence that Lloyd's organization insured the most, and Huntsman 1985 on the other hand provided this detailed discussion of the possible role of mutual ownership in reducing conflicts between owners and policyholders over the level of insurer default risks. He also considered the possible ability of mutual ownership to facilitate risk selection during the formative years of U.S. insurance markets. That stock insurance reinsures less than mutuals. Lamb, Tennant, and Stark 1993 provide evidence that stockholder-owned insurance write more business than mutuals in lines of business with greater underwriting risk. The authors interpret that result as consistent with the managerial discretion hypothesis. Lower risk lines involve less managerial discretion. Kalifner and Doherty 1996 find that stock insurers write more earthquake insurance than mutuals, but they interpret the result as consistent with stock insurers having superior access to capital following potentially large losses. Harrington and Nyhausen 2002 provide evidence using U.S. property casualty insurance data that mutual insurance hold more capital compared with stock insurance and adjust capital more slowly to target levels. Interpreting this finding to mutual greater costs of obtaining capital after adverse loss experience. Zanjani 2007 discusses the role of mutual firms' inferior access to capital in his historical analysis of organizational form in his life.